What's going on, traders, and welcome back to my YouTube channel. My name's Antonio, and in today's video I'm going to be breaking down how I use the two market phases as a benefit within my trading. And as always guys, if you're not already subscribed, make sure you hit that subscribe button so you don't miss any more content. And if you want to join our automated trading service where you can copy our trades for free, just click the link in the description below or message me on Instagram and I'll get back to you as soon as I can. But for now, let's jump straight into the video. Right guys, so before we jump on a live chart example, I just want to visually break down what I mean by the phases of the market and how it can benefit us as traders and just, to understand it. So let's just jump straight into it. So the market likes to move in two phases. The first phase being an impulsive phase, the second phase being a corrective, and then obviously we get that continuation impulse again to the upside. And this is in a buying scenario, okay? This is a bullish scenario. Obviously the opposite of this would be where we get bearish impulsive moves to the downside, followed by that bullish correction to the upside, and then again followed by that bearish continuation impulse again to the downside. So this side on the left, this is our bullish scenario. And what does this mean to us as traders? When the market is moving like this, where we're getting bullish impulsive moves followed by bearish corrections, we want to only be looking for buy positions. And with the sell side, when the market is forming bearish impulsive moves followed by bullish corrections, we only want to be looking for sell positions. We'll start with this side over here. So what is this actually telling us as traders? Well, it's telling us that buyers are driving the market to the upside very heavily. There's a lot of buy orders in the market. And then these buyers are closing their positions and taking profits here, which then allows more sellers to enter the market. Not a lot of them, as you can see, not a lot of sell orders, but now the buy orders have been closed. It allows sellers to enter the market, which is why we get that corrective phase to the downside. And then obviously the most optimal time to enter a buy position would be here. Now it's obviously unrealistic. You're not always going to catch the market there, but essentially where you want to be entering the market is after this continuation phase is forming. You want to be entering buy positions along this ride here. Okay, that's where you want to be entering your buy positions. You don't want to be entering buy positions as soon as this corrective phase has started. You want to be entering it right at the end, because what's happening before here, buyers are entering the market too early, they're then getting stopped out. Buyers are entering the market too early, they're then getting stopped out. This is what the correction does, is it shakes people out of the market. It just builds up liquidity, and then the market goes in a desired direction. Same with sell positions. Price moves to the downside, sellers are heavily involved, a lot of sell orders. Sellers then take their profit here. We then get that correction to the upside. And then of course, the most optimal time to enter sell positions is at the end of the correction, or anywhere after this continuation starts to form. Okay, this is the optimal time to be entering sell positions, because again, what is happening? People entering the market too early, getting stopped out, entering the market too early, getting stopped out, so on and so forth. But another thing I want to mention is, why are people in the market doing this? Why is there impulses followed by corrections? Why isn't there just impulses? And what is actually going on in the market, and why do traders do this? And how do we take advantage of it? So I'm going to talk about that now. The way the market works is sellers are greedy, buyers are greedy. We're all trying to get as much profit out of the market as possible. And how do you do that? So let's say we're entering a sell position from up here, okay? Let's say we're entering a nice sell position and we're targeting this support level down here. So let's just work this out. If that was the case, that looks like a very, very nice risk to reward of a 1 to 10. Let's say that's a nice risk to reward of 1 to 10. But that's just one position. How do traders maximize on their position? So this is a 1 to 10. What happens if we don't target all the way down here, but we target here? Okay, yes, that's only like a 1 to 7. But then what happens if we then enter the market again at this level and then target down here? This is now a 1 to 7 again. That's a 1 to 7, and this is a 1 to 7. So in total, by breaking down the positions, by entering a sell position, closing profits, waiting for price to pull back again, and then entering a sell position again, rather than just one big position. It benefits us because this is now a 1 to 14 combined, whereas it was just a 1 to 10 to start with. So we're maximizing our profits by entering more positions and waiting for price to pull back and form these corrections. Okay, that's why the market does these phases. But anyway, guys, we're now going to go into a live chart example, and we're going to break down how we would actually trade it and how we would use it in our analysis. Right, guys, so here we are on a live chart example. I'm just going to start with my analysis, and we're going to see how we can notice the phases of the market within this piece of analysis. So to start with, we can see how price is clearly uptrending. We're having these impulsive moves. Okay, this is what I'm going to be talking about the most, is impulses and corrections. Okay, so we get a nice impulse move to form a higher high. We get a small pullback, another impulsive move forming that higher high, pullbacks, and then huge bullish impulse move. Okay, so buyers are definitely involved within this market. Then what happens is price fails to form a new higher high. We form a higher low. However, here we fail to form a higher high. We're then failing to form higher lows. Again, failing to form higher highs. So what is happening here is price is correcting. Okay, we're finally starting to do that correction. But just notice the bullish impulsive moves that we are having. We were having bullish impulsive moves followed by bullish impulsive moves all over the place. Okay, so there's definitely a lot of bullish impulsive moves taking place. But notice again how there's no bearish impulsive moves along this kind of uptrend that we're having, until we finally get this huge bearish impulsive move here. Okay, that is our first initial sign that sellers have taken control of this market. Okay, that is what we are identifying here, our first takeover by sellers. It hasn't happened previously, it's only just happened now. Then we get a correction. Why is this a correction? So I'm going to highlight the whole thing, which I would notice as a correction within the market. Why is this a correction? Well, there's no strong bullish impulsive moves like how we were having down here and up here. Look at the size of the candles, okay guys? Look at the size of these bullish candles compared to what is happening over here. Another thing to notice as well is look how long this is happening. We had this bearish impulsive move which started on Thursday at 2 a.m. and ended at Thursday at 2:30. But then the correction that we're having started from 2:30 and didn't end until 7, okay? So this took 30 minutes, but the correction took 5 hours, okay, to do half the move. So what I mean by that, by half the move, is we had this impulse move, which done 63, a move of about 63, but then the correction that we had took triple or quadruple the time to do only 37. Okay, so half the move. So we had half the move in double the time. So it's definitely a correction in my eyes. How would we use this in our analysis? Well, we would notice where the most recent low points are. So this was the most recent support within the market. So that's our most recent support. We broke through support. We then actually pulled back and retested our level of previous support as resistance. But notice how we were saying in the corrections at the start, how it likes to take out the highs and stop people out. We had the high point here, we had the high point here, and then again the final high point, and then we now move into the downside. What other pieces of analysis can we add to this? Let's see. Use a Fibonacci retracement tool from swing high to swing low. And if I just edit this, I'm pretty confident, yep, it's going to be the 61.8, tapping it to perfection. So again, we're just adding our confluences here: impulse, correction, Fibonacci retracement, previous support as resistance. Okay, we're just adding all of these confluences into that. And then that is where you want to be entering your sell position. Now, it's obviously going to be hard sometimes to enter the market there, but you can enter after this bearish impulsive candle, another bearish engulfing candle, but you're still going to catch the big move. I'm just going to draw in this support down here quickly because this is going to be a key factor in this video. Okay, so that is where like the kind of overall target is, where this uptrend started from, originated from. That's where we're going to be overall targeting. Now we have this bearish impulsive move to the downside. Once again, we get this correction. Okay, let's draw on our previous support, because once again, it is being used as a resistance. And what's it doing? It's taking out the high points. So this was the high point. We then came to here, and then once again, we moved even higher. So we're just stopping people out of the market. And again, huge move to the downside, and then this is just a prolonged move to the upside. Let's see what Fibonacci retracement tool says for this. If we do that, this is looking like it could be the 50%. Yep, this is the 50%. So we're lining up the support levels with a key Fibonacci level. So this is a support level which lines up with the 50%. This was a support level which lined up with the 61.8, which we spoke about earlier. And we're getting in the market. So, you know, in terms of entry criteria, I get asked all the time, you know, what's your entry criteria? Well, once I see that sellers are stepping into the market, I'm just jumping in. You know, we get a nice rejection. You might want to enter there. You might want to enter here. You might want to enter here. Either way, you know, you're going to be catching the move to the downside. As long as you're putting your stop loss in a safe position and you're trading in a calculated way, you're not entering randomly or off of emotions, you know, you don't need to be first into the market. You can just enter later on down the line. Now, this is a key thing as well that I wanted to discuss. Notice how we are now approaching this level of support. Okay, we're approaching this level of support. So what do you think is going through sellers' minds right now? What's going through their minds is they want to be closing their positions. There's going to be a lot of people closing their positions as we approach this key level, which means if sellers are closing their positions, what's going on? Buyers are going to be entering the market. So let's just see how price reacts as we approach this level of support. Notice how we're getting more buyers stepping into the market because we're now approaching this level here. So this is what I mean. This is where it now becomes hard to enter sell positions as we are starting to approach this key level of support. Remember what I talked about earlier? The key times you want to be entering the market is at the start of the continuation move, whereas now we're approaching this key level of support. You know, buyers are getting more interested in the market. When you're analyzing your charts, guys, you want to be viewing the market as both a buyer and a seller. You want to have no bias when you're entering trades. When you're analyzing the charts, you want to have no bias. You want to view the market as a buyer, view the market as a seller, and then work out who has the greater edge. And then you can make a decision based off that. But let's continue this and see what happens. Finally get that move. But again, look what's happening as we're approaching it. Buyers are trying to step in. This is where you want to stay out of the market. Okay, this is where you want to start to stay out. But then I think we do finally hit this level. Yeah, we do. We finally hit it. And then price moves to the downside. Okay. But anyway, guys, that is a breakdown of market phases. Okay. Just to recap, if you're selling the market, you want to be seeing strong bearish impulsive moves followed by corrections. And then you want to be entering the market off of these corrections, following on with that continuation. And how do you establish when the correction is over? That's when you use things like support and resistance levels, Fibonacci retracement, liquidity grabs. All of these things is what you use for your entries. And then you just want to pull the trigger. But if you don't get in early, don't worry. There will be plenty more opportunities down the line to get in again. As you can see here, we break through, strong impulsive move to the downside. We then correct, and then you get in again using support turned as resistance. And then you want to get in on that continuation. But don't be trading too close to levels of support where you can see where the market will start to become more volatile and aggressive, and momentum will pick up from both sides of the market. But anyway, guys, that's that video. I hope it was helpful, and we will now go into the outro. Thank you for watching this video, guys. I hope you enjoyed it. And if you did, make sure to leave a like and a comment letting me know your thoughts in the comment section below. And remember, if you're not already subscribed to the channel, make sure you hit that subscribe button so you don't miss any more content. Have a great rest of your week, and I'll see you in the next video.